MillerKnoll's operating income rose 293% this year, from $50.5 million to $198.3 million. Its own adjusted operating income fell for the second year running. One number in the risk factors explains both. The global retail unit's fair value exceeds its carrying value by 1.1%. Not 11, 1.1. 3 defensible ways to read this year, and they do not agree. As reported, operating income went from $50.5 million to $198.3 million, up 293%. Strip last year's $130 million impairment, and last year becomes $180.5 million. So the gain is 9.9%. But that correction is incomplete. On the company's own adjusted basis, the number fell from $248.7 million to $238.4 million. Here's that adjusted line over 3 years next to the cash. Adjusted operating income, $262.2 million, then $248.7 million, then $238.4 million. Operating cash flow, which needs no adjustment at all, $352.3 million, then $209.3 million, then $199.9 million. The 293% year produced less cash than the loss year did. Global retail is the segment MillerKnoll's own 10K calls a key element of its growth strategy. Sales grew 5.9%. Adjusted operating earnings fell 37% to $32.7 million, from $51.9 million last year and $64.62 million years ago. It spent $15 million opening new stores in the year its margin went from 5.0% to 3.0%. The consolidated number hides a real divergence. North America Contract lifted adjusted operating earnings to $213.1 million, from $191 million and $177.2 million. A second straight increase, and it is genuine. International Contract fell to $58.3 million from $73.5 million. Global Retail to $32.7 million. One segment is carrying 2. So was the flat gross margin just mix, hiding real improvement? No. Consolidated margin was 38.8% in both years. Global Retail carries the highest margin of the 3, at 44.5%. And its share of revenue went up, not down. Mix was a small tailwind, not a mask. North America Contract improved 80 basis points to 36.5. Global Retail gave up 140. Tariffs ate the difference. MillerKnoll took no impairment this year, but it disclosed how close it came. Global Retail's fair value exceeded its carrying value by 1.1%. The Muto trade name by 2.1. International Contract by 3.1. The Knoll trade name by 6.8. The filing's words: modest adverse changes in revenue growth, operating margins, or discount rates could result in material impairment charges. Notice which 2 units are thinnest. They are the same 2 whose earnings just fell. Now the leading indicator. Revenue grew 4.7%. Orders grew 0.4% and fell 0.7% organically. Backlog fell 10.8% to $678.8 million. Revenue was fed by converting the order book, not by new demand. And the split inverts the earnings picture. North America Contract orders fell 1.1% organically. International Contract 5.6%. The only segment with orders growing is the one losing money. The balance sheet has a date on it. Long-term debt is $1.26 billion. $25.1 million comes due in fiscal 2027, $25.8 million in 28, $76.2 million in 29. Then $642.2 million lands in fiscal 2030. Roughly half of all the debt in a single year. And the filing says what it is: the revolver and term loan A, both due April 2030. And an earlier date most coverage will miss. MillerKnoll's January 2022 swap, fixes $575 million of borrowings at 1.65%. It terminates January 29, 2027. The replacement covers $200 million at 3.38%. So $375 million loses its hedge entirely against term loans at 5.37 and 5.62%. Interest expense fell to $69.9 million this year. On those terms, it goes back up. At $22.91, MillerKnoll is about $1.56 billion of equity and $2.68 billion of enterprise value. Call it 6.9 times adjusted EBITDA of $386.7 million, below both listed peers. Now a scenario model, and these are assumptions, not forecasts. Flat revenue at a 5.2% margin implies about $9. 2% growth at this year's 6.2% margin, about $21. 3% growth back to 7.2, about $33. Implied value under stated assumptions, not a price target. The bottom line, MillerKnoll did not recover this year. It stopped writing things down. And the wider point, a percentage that looks spectacular usually says more about the year before it than the year it describes. No analyst wrote this. Every figure came out of MillerKnoll's own XBRL, the tags data inside the filing. And the same pipeline reads any of the 10,000 companies that file with the SEC. A private company reporting in the same format is the same job. This entire analysis was built on the RoboSystems SEC Shared Repository. Structured filing data for every public company that files. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL. If you want to run your own deep dives like this one, the link is in the description.